Hi there and welcome to this video, which is hopefully going to explain to you how to trade the long straddle strategy. My name is Gary Doyle. I am the senior trader for OptionsTekkers. We trade foreign currency and options. So I'm going to show you the long straddle strategy, which is really used by options traders to take advantage of expected upcoming volatility in the markets. So first thing you need to do is to find out what high risk macro events are going to be occurring so that you know when to plan to place your long straddle trade. So where can you do that? Well, if you go to www.OptionsTekkers.com, you'll find everything you need to trade this strategy. Under the education section, you can click on option strategies. You'll see all of these strategies. The one that we're looking for is the long straddle strategy. So I'll just explain the strategy first of all, and then we'll go through the steps of actually trading it. So long straddle. The long straddle strategy allows the trader to profit from expectations regarding upcoming high volatility in a currency pair. The trader should purchase an at-the-money call and put. However, the strategy incurs high premium costs, so for the trader to be able to make a profit, the currency pair must be highly volatile. So that's what I said, it needs to be highly volatile. When do we use it? The strategy will work best when the trader believes the pair will be highly volatile in the near future. So we're going to look in a second on our economic calendar to find high risk macro events that we could potentially use this strategy to take advantage of. The setup: so you buy an at-the-money call at strike price A. You buy an at-the-money put at strike price A. When implementing this strategy, the pair's price will be at A. So this is a little diagram. This is A, this is your loss, and this is your profit. The worst thing that can happen with this trade is that you pay your premium and the price doesn't move. There's two break-even points here and here. Ideally, you want the price to move wildly, swing in one direction. You'll lose on one of your trades, but you'll win on the other. And the upside is unlimited. Move on to that. Maximum potential profit. The maximum potential profit is unlimited. Maximum potential loss is what you paid for your premium. Now, there's something in options trading called the time effect. In the long straddle strategy, the time decay works strongly against the trader. As time goes on, the value of both options decreases. So really, you want the market to move quickly and get out of your trade quickly. So with these high risk macro events that we're going to be looking at, that's exactly what happens. Best and worst case scenario. So the best case scenario occurs when the pair's price increases or decreases by a large amount. And the worst case scenario occurs when the pair's price does not change by the amount needed to start making profit. Tips for trading the long straddle: it will work best when major events that are expected to highly increase volatility will occur in the near future. This anticipation enables the trader to create a long straddle in a limited time period and thus limit the premium costs. Doubling the amount spent on either the put or the call will mean that the trader still expects high volatility but has a belief in the direction the pair will move. Using this belief to the straddle, it changes its name to strip if the belief is bearish and strap if the belief is bullish. But we're going to presume that we don't actually know what's going to happen. We're expecting a high risk news event to happen and we don't know the outcome. How do you know when the high risk news events are coming? Well, you go to your economic calendar. There's one that you can use for free on OptionsTekkers.com, and you're looking for any news event that has high next to it. These ones are all done for today. Let's have a look. We've got some retail sales from the US and job sales from the US coming out shortly. The ones that you really want to be using are going to be central bank rate decisions and the non-farm payrolls job report out of the US. So let's just say, for the purposes of this demonstration, that the non-farm payroll report is coming out of the US. It's coming out at 1:30 first Friday of every month, and we're looking to place our long straddle trading strategy. You want to do it about an hour before the news is going to come out, because you're expecting volatility around the news events. You need to be in the market beforehand. Now, first thing you need to do is set up your trading platform if you don't already have one. On OptionsTekkers.com, you've got a free trading platform that you can use. You just click here to sign up. I've already got an account, so let's just sign into that. Now, I'd highly recommend that you practice this strategy on a demo before going with live funds. Make sure you're comfortable with using it, and then that should put you in good stead. Right, so let's say, like I say, non-farm payrolls is going to be released from the US in about an hour. We'll trade on pound dollar because it's slightly more volatile than the other pairs. So go to pound dollar. We want to add a position. Now here we've got our call in place already, but we need to turn into strategy, so we want to add another line. So now we've got our put. Here you can choose the amount. At the moment, if we were to buy both of these, we'd be paying £944.31. That's our premium. That's the most we can lose on this trade. You can change the amount here. So I don't know, let's just put the minimum. So here you say we're paying £47.21. Here you've got scenarios, so this is quite important. We click on scenarios. It tells us what are the worst and best case scenarios. So here's your price, here's your premium, and this tells you how much profit or loss you can make on there. So worst case is it doesn't do anything and you lose about 13 quid on that trade. Best case, we could be 200, 300 quid up, which I'm sure you agree on a £50 investment is not too bad. So all we do is we press trade now. We'll put no thanks. And we're in our trade and we can see it. Here's our strategy, here's our expiry. So this trade is valid for 7 days. Like I say, time decay is important in options trading. We want to make sure we're out of this strategy quickly. When the news comes out, we'll be listening. If we go back to the website again, OptionsTekkers.com, on here you've got tools, so you've got your economic calendar, but also on there you've got a live market squawk. If I can get it to work, live market squawk, and that'll take you to a live squawk. That'll blurt out the news as it happens. You just click listen here, click Forex, and now that's playing, and that'll blurt out the news as it happens, and you can see all the news events that have happened today already. So that's our strategy. I hope that's been helpful. The other thing that I should show you is how to close. You just click close selected positions when it enables you to. So you need to select the item here and you can just close here. So we're not going to do that now because we're in a loss. Idea is that we close that when we're in a nice bit of profit that we're happy about. And also just make sure that you take your profit when it's presented to you. So that's the long straddle options trading strategy, best used during high risk macro events. I hope you found that really useful today. If you have any questions, feel free to contact us via the support page on the OptionsTekkers.com website. Thanks for listening and speak to you soon.